These are not easy markets at the moment. Price is very choppy. However, here on the pound Swissy, we have a potential breakout brewing, and we also have, as you can see, numerous bounces off this current area of 146. And in the last week, you could have shorted here on 4 or 5 occasions, and every trade would have won. It's more clear here on the 4-hour chart, but multiple opportunities to short here and multiple opportunities to long around here, and all would have been winners. If, on the other hand, you are trading purely from the trend, you have a number of options. One is that you can wait for price to come back down here to this trend line, look for horizontal support and resistance as well, and look to take the trade for a potential bounce back up again. The further option is what is known as a breakout trade, and this is usually my main strategy, but as I've explained earlier, markets have been difficult, we have to be flexible, and I have made most of my money this year simply from bounce trades. But the way that a breakout works is as follows. We will look for price to break and close. The candle must close above 146.00. Once price has broken out and closed above this line, we then look for the following candles, ideally the next one, to come back down, touch the line with a view to a further move upwards. As we're clearly in an uptrend, then that would mean we will be trading with the trend. And a further point to give us confidence is that this time last year, price was over 150. So there is a potential here, once price breaks, that it could go another 400 or 500 pips. Technically, there is a further indicator. I will explain this in more detail later, but this is what is known as a potential triangle breakout. And you see here we have a triangle pattern, and the theory goes that you measure from the bottom of the pattern to the top, and the middle figure there is 429, 427 pips, and the theory goes that once you get the breakout, that move will be replicated here, which would again take us up to where price was this time last year. So a number of reasons why this pair is interesting. It's not one that I normally trade, it's very volatile, and for new traders I don't recommend it. But if you're trading simply from trends and breakouts, you can use this strategy on multiple pairs. A further option here is that price could break and close below this daily trend line, and if that was to happen, then price would come down here. We would then look for a pullback candle to the line with a view for a further fall. This is the dollar yen, and you can see that from November of 2011 right through Christmas and January, price was simply bouncing off 78.20. And if we were to go back further, you can see that this line has been important for many months. See here back in July 2011 how important it was. Notice this big candle here and this big candle here. These two extreme candles were when the Bank of Japan intervened in this currency. The Japanese yen was getting too expensive and it was killing their export trades, and therefore the Bank of Japan got involved. It's known as intervention, and basically they sold their own currency in huge amounts to weaken it. So ignore those spike throughs, but they are important in terms of why we wouldn't, and why I advise not to take a short if price was to break out of this range. So November, December, we get to the end of January 2012 and price starts to break out of this area. I recommended to my followers not to touch it, and it was because of the BOJ. However, in the middle of February, price finally broke and closed above this line. And this is a classic breakout trade. I've zoomed in now to show you the move, and what happens. Price clearly, finally, after many months, breaks and closes above this all-important area of resistance. The very next candle in this example comes back down and touches that line, and then price moves away. This is a classic example of a breakout trade. Sometimes it will take 2, 3, 4 days for price to come back down, but the nearer to the candle that breaks, the more confident I am. You can also take these trades on 4-hour charts. Here you see on a 4-hour chart, price came through, 6 candles later, finally price then moved away, but we have the breakout and then the pullback. Then in March, on the dollar yen, price on the daily chart came, broke through, closed above the all-important 8200, previous area of resistance. The very next candle comes back down and almost touches it, the second one does, and price moves away another 100 and odd pips. And you can see here, perfect example of previous resistance becomes support, support, support. Price spiked through on numbers of occasions. Finally, price broke through and then moved down. At this point, you could be looking for a pullback to the 8200. Remember, we go to 8190, we go 10 below the area. This one fractionally missed it, I seem to remember. Yeah, the high there was only 8185. But it would be counter trend, but it is a breakout. So you get the break below the major area, the pullback with a short. Similarly, the Aussie dollar yen. The Aussie dollar yen, February, price came up, closed above the all-important 8500. We were in an uptrend. Price, the very next candle, comes back and touches it, and price moves away. Price again proved here to be very important and supported, and was support, support, support. Finally, price came back down. Second candle along, comes back, touches it, passed it a couple of pips, and fell away 300 pips. This is the Euro USD, and the Euro USD, as you know, last week broke through the all-important 13200. Was messy, but it has been support, 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 messy resistance around this area, but it is an important area. Now on the 4-hour chart, price came down, broke and closed below, and the very next candle pulled back, touched 3200, and price then fell another 160 pips. On the daily, I am still interested to short this pair. We are in a short-term downtrend, and a further indication for me, a further clue that price may be about to turn back down, is Fibonacci. If we fib the recent low to the recent high, in the very same area we have the 50% fib, which is an important line in the sand. A final thing to note is that the average range over the last 30 days is around 100-110 pips, and this move here will be approximately 100 pips on this candle today. So I have an order in place, and fingers crossed that price will then fall away once again. This is the Euro GBP. 8300 has been a major area of support going back to the beginning of the year. Finally last week with the FOMC news, price piled through. On the 4-hour chart, once again, price pulled through, the very next candle came back and touched, and away it moved. I am still waiting for this on a daily chart. Now ideally I would have liked this to have pulled back up here within 2 or 3 candles, but this is still a major important area of support and resistance, and therefore I will be interested to short the euro pound in this area. Here I want to show you a couple of more complicated potential trades, why I didn't take one on the pound and why I definitely didn't take one on the CAD. Here on the pound dollar, if you remember from an earlier video, when price broke this upper area here, the all-important 160, I said that I would not take this trade. And the reason why I didn't take this trade is that this upper trend line that we'd had in place was a major area of previous resistance. And therefore the potential here, I would have needed my stop to be below these recent areas here. So I would need my stop to be 40-50 pips away, and we were looking at a potential gain maximum of say 60 pips. As it was, that turned out to be exactly the case. Price turned down and moved back down again. Price then pulled back down to our 158.00 area, and we had a number of opportunities to long there now. Now, in this case, if price breaks and closes above 160 on this occasion, and I would prefer it to be more than the case here, it only went 3 or 4 pips through, but if it was to close above this area, say above 160.10, and the candle formation helps as well, I will be interested to long this pair, because I'm still only needing my stop to be 45-50 pips away, but the potential gain now is over 100, and therefore a 1 to 2 risk reward ratio, yes, I will be interested. This is the CAD, and as you know, in the last 10 days on the 4-hour chart we have had multiple opportunities to short at the 1-0 area, and we've had opportunities to long at 9900, and I had an 80% win rate here. However, price then broke and closed above 100. I did not take this trade, I would not take this trade, and I'll explain to you now why. Here is the CAD on a weekly chart, and going back to last October-November time, price has clearly been in a downtrend. This pair has actually been in a downtrend since, I can remember in 2009 shorting this at 128, and therefore this has been a huge major move over many years. Therefore, I would only be interested to short if price breaks and closes firmly below 99.00. I would not be interested to long in its current position because it is so obviously counter trend. On the daily, you can see how price did break through. The next candle came down. This is indecision candle, hanging man at the top of a move, and as it turned out to be, this is definitely a reversal candle. Now this is complicated to short because 9900 on daily charts has regularly been broken. This case would have won, that one would have lost, that one would have lost, and therefore this has been very messy. There are two options with this. One is you can put in place a trend line here, anywhere around there, and you could be aggressive and say, okay, when price breaks the trend line and the 9900, I will short on a pullback. So if it pulls through, pulls back, then you can be aggressive and go that way. The more conservative option is to wait for price to break and close below the lower area. It means that you potentially leave 50 odd pips on the table, but it is a more conservative entry. A further option is you could wait for the weekly candle to close, and if the weekly candle closes below this low point of 98.90, so let's say if it closes below 98.80 on a weekly chart, because that would be the most it's ever done in the recent months, then you would be interested in a pullback for short. The positive thing is that with this pair, the price did get down to 9300 in June of last year, so there is a potential here of 500 or 600 pips movement. On to the next subject.